Good afternoon, everyone, and welcome to this TradeStation webinar. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. Always a pleasure to be here. Thank you for taking time out of your schedules and also learn about the TradeStation platforms and how to set up some trades. Today, we have our guest speaker, Brandon Wendell. We're going to pass the microphone over to him in just a moment. But this is Options Replay, strategizing your options trades. Every 2 weeks, we get together and we talk about the markets and how we can strategize by placing options trades. We alternate options replay also with futures options once in a while. So make sure that you check out our events calendar, because sometimes we're going to replace options replay with a futures options replay, which is, a very similar type of webinar where we come on and we talk about examples and trades that could have happened, that could have worked or not worked, and the reasons why a trade may work or not. So always mark your calendars for every 2 weeks, starting, today, Monday. And yes, always check the events calendar to make sure that we're all aligned on the dates and the times. Thank you for being here. As I said at the very beginning, let's go through some disclosures. Just keep in mind that every symbol and idea that we talk about is for educational purposes only. These are not recommendations of TradeStation. Also, active trading is not suitable for everyone. It has risks, and everybody needs to be aware of that, especially when it comes to trading options, which carry a higher degree of risk. So make sure that if you need additional information on this, go to www.tradestation.com/important-information. Also want to note that even though it's a pleasure to have Brandon here with us today, he's not affiliated with TradeStation. He's just a guest speaker, and his ideas and methodologies are his own. Brandon, thank you so much for being here and presenting this information for us. I wanted to also point out where the archives of these presentations are. So I have here on the screen the TradeStation website. I'm going to hover over Learn, and this is part of the Options Education Center. So once you land on the Options Education Center, which should be loading here in just a moment, scroll down and you're going to see a box for Options Replay. I'm sure you've already joined the webinar. This is a recurring type of webinar. So if you sign up for one, you'll be invited for the upcoming ones, but just make sure that you register. And if you want to watch a previous session, just click here or watch previous. And we have a collection of all the webinars that we've done in the past, being the most recent one, the bigger box. If you scroll down a little bit, you'll see historical presentations, and we title them differently based on the type of strategies that are covered so that you know exactly what the webinar talks about, okay? So make sure that you come here and explore and see if you see something to your liking. All right. I think that's enough of an introduction. Thank you so much for your time, and I'm going to pass the microphone over to Brandon. Brandon, thank you for being here. I'm going to shut off my camera and my microphone, and the floor is all yours.
All right. Well, thank you very much. I appreciate you guys having me, and I'll go ahead and share my desktop with you. Let's see, my screen number 1. There we go. So welcome, everyone. You might wonder why I'm wearing such a bright yellow shirt. It's because I'm actually refereeing high school soccer right after this. Actually, I've got a JV and a varsity game. So this is my Virginia High School League soccer official uniform, U.S. soccer certified, so all that good stuff. But anyway, that doesn't matter today. What matters today is my certification in trading. And basically, whoops, sorry, let me get my screen going here. Kind of jumped on me there. All right, there we are. And welcome back to Options Replay. And basically, I wanted to kind of open it up to see if there are questions on things we've covered in the past, as well as things that we might want to cover here in the future. I know that there were some questions that came up previously. And as you can see, I've got a few open positions right now. Some of them are a little more advanced, believe it or not. I'm also waiting for an email that I sent myself for a file coming up. Hopefully I get that in a few moments. But yeah, some of these, the Hershey was actually one that we went over a couple times. It was a straddle. Obviously, it's gone negative now because of the underlying price. Let's see, we did the 160s and we're only at 166. So the time value is completely eroded. And we watched that one as it was still profitable and manageable at that time. Micron, this one is actually kind of interesting. It says custom, and it shows it's up by about $100 right now. Some of these strategies, if you're not familiar with them, by the way, they are all covered in the Options Education Center. So if I go over to that, let me see, I'm actually in the events page right now, but if I go to Learn on TradeStation Options Education, close out my other page here, speed up the computer a little bit, there we go. Under Option Strategies, one of the things that I did was created, I believe, let's see. Oh, that's what it was an arbitrage opportunity. So right here, conversions the art of options conversions. There was actually a webinar, I believe, with someone from let me click on it because I can't remember who it was off the top of my head, but there's a webinar that was done. Yeah, there's the webinar you can watch. Anyway, with these conversions, what's happened is I have a long position in the stock, and that's Micron, but I also have a synthetic short. Now, in order to do this, you actually have to be able to do, I believe this one's going to be a level 5 option. So it's much more of a risky strategy. And the reason why, as you can see, I've got a call, a 105 call, and I went long in the security. I'm not sure, it doesn't show me my strike price or my actual underlying price right there, but I can go into my trade manager window and probably find that. Anyway, I've got a synthetic short because I'm long a put and short a call. So that basically gives me that synthetic short position, which is offsetting my long position for the stock. So I'm possibly losing a little bit on the stock for the long and gaining on the short, but I'm actually gaining a little bit more than I'm losing. So my overall net position, believe it or not, is positive. And that's due to inefficiencies in the market, a mispricing in the market, if you will. And I think, is ball another one that I did? Just want to check because I do have same thing. And there it's the same. It's actually long. You can see a little bit differently here because the equity separated. So the equity is down 175.50 on the long position, but I have a synthetic short. And notice the synthetic short is actually profitable by a little bit more than what I'm losing. So I've got a net profit of $12 on both of these positions. The other one's a futures position, and the Hershey, again, we're not going to worry about that right now. But basically, the reason why these were advantageous to put on was a mispricing in the options. Options prices, they're derivatives. They derive their value from the underlying security, okay? And they're separately traded though. So even though they derive their value, remember the delta, the Greeks, the delta, vega, theta, these are Greek measurements of risk that influence the options price. But there's one other thing that also influences options pricing, and that's supply and demand. For instance, if we go back to Micron and take a look at the options there we go. And it doesn't matter which ones we look at. I just happen to have, let's see, which ones am I in? Those are the August. So it's got some time left in that, which is good. Actually, I wanted to have time left in that. But obviously, if we take a look at any of these option sets, you see the ones I'm actually in right there, plus minus right there. Any of these, the bid ask is going to be influenced by the market. We're looking right now at the Greeks, but I can change this to also take a look at volume and open interest. Or is it open interest? There we go. Excuse me, allergies. Anyway, now you can see volume and open interest. If there's higher volume or higher open interest, there may be more activity in that particular security, and therefore pricing might be a little bit better. When you go further out in time, I actually see pretty good volume on these in Micron. Specifically the ones that I'm trading, which were 105, I believe. Yeah, 105s. And we're currently trading at 66. So obviously that long position is deep out of the money. I can't even see this. I have to go to all strikes in order to see those. This is how long ago it's been. There we go. No, actually the ones I'm in, there we can see them now. And you can see that the open interest, there was no volume at all today, but 334 open interest. And you can see there's a lot of open interest on those options. And on the call side, same thing, lots of open interest. As a matter of fact, there were 55 contracts traded at the 105 calls today, almost 5,000 open interest. Now, one little thing you'll notice, not so much in this, but in some securities, if you see that the volume is higher than the open interest, for instance, watch this. If I go to X, see if I can find it here. Yeah, it's loading. But one thing you'll notice is that typically the open interest is higher than the volume. And that's just because, people are actively trading options, but they're also holding them a little bit longer. But every now and then you'll see volume higher than the open interest. And actually, let me get rid of all the strikes, go back to just a few. It'll make more sense. There we go. And take a look at the volume on these 0D, the ones that expired today, compared to the open interest. When you see high volume, and this works the same way on futures as it does on options, when you see the volume is much higher than the open interest, it typically is indicative of a lot of day trading going on. People are flipping those things. And you'll see that. You'll see a lot of volume on securities that are being traded throughout the day, in and out, in and out, in and out. But when you see high open interest compared to the volume, people are more or less holding on to those a little bit longer and not necessarily day trading them. So I go out to this weekly from August, maybe. There we go. And again, you can see open interest, volume is lower. Open interest 135, volume 13. Meanwhile, the ones today, other way around, 33,000 volume, only 2,400 open interest. Because most of the people who traded that basically exited. 31,000 contracts were day traded and there was no open interest at the end of the day. So if you're trying to figure out, is this liquid? If you're going to be short-term trading in something, typically you want to see high volume, maybe even higher than the open interest. And that'll show you that that's a pretty liquid security. You should be able to enter and exit it relatively quickly. Now, going back to Micron, I was actually not looking to do that here. And also in Bell, I was actually looking for an arbitrage opportunity, which is not all that common, but does happen. As you can see, when I go to my manage with these arbitrage opportunities, I'm not making a huge amount of profit. Matter of fact, on Ball, the total net profit is only $12. The options are 187.50 and 175.50 is the negative on the equity. Meanwhile, if I go here, let me see, can I split these up? Split. There we go. Nope, it splits out one share. That's not what I want to do. I wanted to split the options out. Let me see if I can do that. That's weird. It's not letting me separate those. I know there's a way of doing it. I just figured out how to do it right now. I was trying to separate them the way I had it on the other one, but that's okay. Either way, taking a look, you can see I've got a positive $104. I had a little bit better arbitrage opportunity on this one right now. Again, when I put on the long opportunity, and I go back to when it was actually entered to see exactly what my cost is. As a matter of fact, I can go into my trade manager and figure all that out if I want. But basically what happened was I put on the synthetic short, went long in a put, short in a call, and I also bought 100 shares. So basically I'm net neutral. So when the prices move up or down, it doesn't matter because my delta should be close to the one. Again, when you take a look, I'll go back to Micron options and just demonstrate. Again, it's August. I'll use the current price and I'm going long the put, short the call. And unfortunately I did 5. I got to change my defaults here. Let's do that real quick. There we are. And preferences, I think. Come on. Computer's acting really funky today. There we go. Order entry and options trading. There we go. I just wanted to change that default 1. There we go. Anyway, so getting back to this, what you can see right now is if I go long the put and short the call, I have a delta of negative 99.99. So basically I have a short position in the stock. It's almost identical to a short position. If I did just the opposite where I bought the call and sold the put, do that right? Yep, bought the call, sold the put. Now I have a positive 99.99. Basically, I have a 1 delta or 100 delta, which would be the same as if I were to go long on the stock. So if I take it, analyze, there's my risk profile. It looks the same as owning the stock because I'm buying a call, selling a put. I have a synthetic long. Now, I do this because, again, of arbitrage opportunities. And if you go back to the art of options conversions, market efficiencies, these are not necessarily the most easy things to identify. However, we made it a little bit simpler for you. Obviously, you got the webinar, you've got the information here for the strategy. And what we're looking at, what's called put call parity. And basically, the stock price plus the put price should equal the call price plus the present value of the strike price. What the heck does that mean? Well, there's financial calculators that help you do all this, so you don't have to do all the math yourself, right? Well, basically, again, we try to make it a little bit easier. There's a worksheet that's downloadable here, and in that worksheet, as I download that, there it is. There should be instructions for it as well. There's the PDF and the put call parity worksheet, which I'll open. There we are. And the instructions are there as well. As you can see, you'll notice there's 2 types of options that this can be used for. European style options, which is usually the easiest one to calculate put call parity because they are European style. You cannot exercise early. Those can only be exercised at the expiration. American style options, the values are going to be slightly different because they can be exercised early. You can have an early assignment for sellers. So theoretically, it's definitely easier if you use European style options, which we have on the index. So as an example, if I go back to the index on OptionStation Pro, we're looking at actually I'll do NDX.X, NASDAQ 100 options. And we'll just check to see if there is put call parity. Remember, the options should be pretty fairly priced based on the underlying security. However, because of market forces, supply and demand that act independently on the actual options, sometimes there's mispricing of a few cents. And as you can see, one was $12, the other one's over $100 right now, which probably pretty good. I should probably exit out of that one because I have a pretty good disparity between those two in arbitrage. So let's go out to say September, 150 days. And here we are on the NASDAQ. Currently, the NASDAQ is traded at, the index 17,808.30. So we bring back our worksheet and the underlying symbol. I'm using NDX. Let's put that in there. So again, NDX and the discount rate, we would just basically look that up. That's the Federal Reserve discount rate that we're looking at, which is about 4.5% right now, I believe, but I can always verify by just doing a quick Google search, and it's 4.5%. That's what I thought. It doesn't change all that often, okay? This will be recorded. Yeah, all these are recorded. Again, if you go back to the Options Education Center on the home page, where I was, right there, options replay, all the previous sessions. You just scroll down a little bit and there they are. So you got all the different ones in the past. So they're there. Anyway, getting back to our worksheet, NDX, great. How much time to expiration in months? Well, we're looking at, what was it, 7 months roughly? The option strike price, and actually let me shrink this down a little bit so we can go back to my OptionStation Pro, and we'll do the at the money option of 17,800, 17,800. And it tells me what the present value of the strike price currently is. And while I'm here, I'm going to enlarge this a little bit so we can see this. It's all pretty self-explanatory. And again, there's instructions on the worksheet as well. So based on 7 months until expiration and option strike price, the actual value with the discount rate is a little bit less than the actual strike price. Now, it says for the European style, we'll go ahead and enter 2 variables and leave the third blank. So I will enter, let's see, 17,800. There we are. Bring it down a little bit so we can see it. The current put price, we'll use the bid, or sorry, the ask, 1213.80, 1213.80. And the current price of the underlying we see is 17,808.30. And that's it for the European style. It says, does put call parity exist? The answer is yes, which means there is no arbitrage opportunity. These are properly priced, which is what you'll most likely get with a lot of these. But every now and then, you're going to see that there is a put call parity issue in arbitrage where it says, no, that does not exist. And what I like is over here, the American style gives you a little bit more information as to which one might be overpriced or underpriced. But basically, again, the calculation should be, and I think I showed it on this here, on this page, the strike price. Oh, it was from the OIC. That's who did the work, the webinar. There it was. Anyway, the calculation, where'd it go? Come on, here you go. Options conversions, learn more. That's weird. It's not giving me that page again. Oh, maybe it was back. No, there it is. What was this? All right. So right here, this calculation, the stock price, which we know the underlying, the NASDAQ price plus the put price should equal the call price plus the present value strike price. So basically, we don't know what the call price was, although we actually do. We can actually plug this in and see if there actually is put call parity or if one of these is mispriced, right? So the stock price right now is at 17,808.30. And actually, let's do this calculator. 17,808 point, missed one. 17,808.3 plus the put price, which we saw 1213.80 is 19,022.1. So basically, according to the calculation here, that should equal the call price plus the present value of the strike. Well, the present value of the strike, according to our calculator, is 17,348.78. So let's subtract that. And therefore, the call should be 1673.32. What is it right now? The call is actually 1486. According to this, there is a mispricing. Of course, this is also after hours where the bid-ask spreads and everything changes, so it may not be as accurate as when the markets are reopened. But if that's the case, we could potentially buy that call for less than it's actually worth right now. That value should be much higher than it currently is. And you can even take a look, theoretical value, look at this. The theoretical value of that option right now is $1,520. You could potentially purchase it for a lot less than that theoretical value. Notice over here, though, the theoretical of the value of the puts is pretty much in line. There's not that much of an arbitrage opportunity, but the calls may be mispriced. So what does that mean? Well, if the calls are undervalued, like you see right there, it's well undervalued. And that one, again, it may be skewed because it's after hours. You notice that the skew is not really as big here or on these. 20 points. Even this one, 1471, 1429, that one's pretty big still, almost 50 points. But there's a pretty big disparity there of almost 45, 50 points between the price it's trading at and the theoretical value. So unfortunately, we can't actually sell short the NASDAQ and put on a synthetic long to take advantage of that. That's the one drawback on this, is you can't actually trade the underlying index. You could do futures though, and possibly do an option on the futures there. So let's go to an American style option. It doesn't matter what security, I'll just do Amazon. And this is American style where we can actually own the underlying security. And again, I'll use August. Let's see, actually, let's see. No, I'm sorry. It was only 5 months, not 7 months. That's why 150 days. It's only what, 5 months? It's 30 days. So I had the calculation wrong. First of all, not 7, should have been 5. And you see the value is still not quite there. And again, still call parity. Anyway, now if we change this to Amazon for the underlying symbol, once again, discount rate remains the same. Time until expiration, 150 days. That is 5 months. Okay. And the option strike price that we're going to be using, let's see, we can use 165. So I'll use that. Well, it shows that the actual present value is $162, not 165. That's the present value of the strike. Now, this is an American style option right here. It says, okay, for American style option, enter the option price, call option price, and the put option price, and leave the current price of the underlying blank. And then instead, we're going to fill it on this area down here, current price of the underlying, which happens to be 167.25. Now, let's go back and fill out the rest here. So I'm going to leave this blank, and I'm going to put in the call option price and the put option price. Call option price is 2010, and the put option price of 165 is 1475. So now when I go back, you can see put call parity does not exist, although that doesn't really matter because, again, we're dealing with not a European style, we're dealing with American style. All this, nothing you have to do here. It's all filled out for you automatically. It does the calculations. But what happened now is it's saying that the call is overpriced. What does that mean? If the call is overpriced, something's overvalued, you'd want to sell it, right? Well, if we want to do that, we could sell the call and buy the put, create a synthetic short. At the same time, to cover that, we would buy 100 shares of the stock. Obviously, the market's close. I can't do this currently, but let's take a look at that call option, 165, and you can see that the call option is theoretical value 1916. Let me go ahead and, whoops, not that. Get rid of some of those rows. Again, I don't need the open interest and volume right at this moment, so I'll get rid of those. But there we go. Theoretical value right now for the 165 is only 1916, and you can see bid is 1990, ask 2010. Might be able to get that for less than it's worth, or sorry, sell it for more than it's worth. So we would look to create a position where we'd sell the call, we would buy the put, and we're not paying too much over value for the put. You see it's 1412, 1475, a little higher, obviously. And right here, we're almost $1 higher for the call. Well, actually, if we do 1990, it's about, what, 70 cents higher? So there's an arbitrage opportunity. Let me get rid of the other two. But again, because we're not going to be naked on that call, what we would also do at the same time is we would go ahead and buy 100 shares of the underlying stock. So we'd have to add that in as one of our, either do that first and then come back and put on this position. And when you analyze this, it's going to look like you're short the stock. Again, our delta is negative 100 because we are long a put and short the call at the same strike price. So what should happen is it doesn't matter if prices go up or down, because if prices go up and we're long the stock, we profit on the stock while we lose on this synthetic short. If prices go down, this synthetic short gains in value from the negative delta while we lose on the stock. So in theory, we actually have a neutral delta of 0 because 100 shares long, again, if I go back to manage here, 100 shares long is a positive delta of 100, while the synthetic short is a negative 100 delta. So what happens? This is the profit that I gain from the offset or mispricing of those options. So in this case, it was mispriced by $1.04. Right now we're looking at mispricing of about, what was it? About 80 cents here, except we're overpaying on this side by 60 cents. So it might be 20 cents total. So $20. Again, it's not always going to be a lot, but it doesn't matter which direction prices go up or down. Just time passing and the decay of the options. Remember, we have time decay with coming to these options as well. Eventually, the values are going to adjust and we can exit when they actually do start to adjust. That overvalued call that we sold should drop in value. We could buy it back cheaper, and that's where we gain that profit. And you see that profit, as I said, right here. Micron, I made $104.50 if I were to close that out for that profit. On Ball, wasn't quite as exciting. As I said before, on Ball, it's only a $12 profit because I'm losing on the stock, but I gained on the options because they were mispriced at the time. I'm not sure if it's still showing the same mispricing. We can take a look. Matter of fact, if I go to Micron instead of Amazon, and these are the August options, so we'll go back there. And remember, these are way out of the money now because I did this a long time ago. So we'll go ahead and bring up all here, and it's the 105s, right? So once again, I just use my worksheet. Go back, Micron for the symbol, and we're dealing with options that have 150 days left, so 5 months until expiration. The strike price is 105. The actual value is 103.09. Present value, the strike price. Call option price. Again, we just plug in the numbers. And the call option for the 105 is, if we were to sell it, 125. And the put option price, you could do split too, or do, if we were to buy this one, 38.85. And the underlying security currently is at 66.74. And right now, put call parity exists. These are priced properly. So call price minus the put price is negative 37.60, and it's in between the upper bound and lower bound. So neither one of these, the call or put, are overpriced or underpriced. What does that mean? It was undervalued when I put in this position, and I've now made my profit. We've gone back to parity. I should probably lock in my profit at this point. I still have a lot of time left until the option expires, but it's no longer mispriced. I already made the profit. I caught it when it was very off, which is good. The unfortunate thing is there's no easy way to do this. I have to keep going through different options and kind of experiment to see, but you get kind of an idea if you notice when you look at theoretical values compared to the actual values as well. That can give you a little bit of a clue as where to start looking. These theoretical values are so far off right now compared to the actual value. Look at that. These are trading way under both of them. And at the time, it wasn't quite the same. This was actually overvalued, and that's why I sold it. Now it's undervalued, swung the other way, and that's why I had that profit. Same thing if I go back to Ball Corp. On that one, what do we have? Again, August 15th, 50 strike, right? And again, I'm long 100 shares. And you could do the same thing with a short position, and you would buy a call, sell a put. And that would be if the put was overvalued. And we would get that again from the calculator. So for instance, if I have, let's see, I have to change the price. Let's say the put option price was actually 27.54. See if that works. Nope, there the call's overpriced still. That's why I need to go above. Let's go 42.15. There you go. And the put is overpriced. So whichever one is over, you would want to sell, and the undervalued one you'd want to buy. So whichever one you're selling, let's say we're selling the put, okay, we're going to buy a call. That means we have to short the stock because we're shorting a put. Sorry, we're selling a put. So we need to offset that. If we're selling a call, we have to cover that call by buying the underlying stock. So you can't trade this naked. It wouldn't work. I mean, you could just put on a synthetic position if you wanted to, but then you actually have to have the right kind of option level 4 or level 5, depending. So why is the theoretical value different for the MU call option very different than the actual? Part of it is because of the time of day, the markets are closed, so the values go way out of whack after hours. But during regular market hours, they'll be much closer typically. I should have taken a screenshot of that, but if you look tomorrow when the markets are open, typically it'll be closer to the actual value. But again, I can take a look at Ball right now, and I did the August on that. So we go back to options. Sorry, what strike was it? 50, right? Before I forget. Yes, 50 strike. So here we are with the 50 strike. That's September. We want August. There they are. You can see the ones that I'm in right now. And right now, that's trading pretty much right there at theoretical value for the puts, 444, 430, 560. And the calls are trading pretty much close to theoretical value. So it's not that far off at this point. So I can't imagine we're going to see a really good parity. Mispricing, we might be at parity. Again, Ball is my symbol. We're using the 5 months. Nope, actually August is 115 days. So was that 4 months roughly? I could put in 0.123, 0.25 or 0.5. So 115 days. Yeah, it's just a little under 4 months, right? Because 4 months is about 120 days. So technically I should do like maybe 3.75, and the strike price is 50. So the value is pretty close, 49.32. Call option that price is 225 for selling that one. And the put, I could use 560. And we see the put is a little bit overvalued at 560 right now. Well, it makes sense because the theoretical value is 444. Meanwhile, theoretical value of the call is pretty close to where I was. Now, if I use the other prices, let's see if that changes. If I use 430, because that's where I would sell, and I would buy at 330, the call, it's still saying the put is overvalued. So there may be an arbitrage opportunity based on, right? Did I forget to change? I did. Forgot to change one main thing there, the underlying price, 47.30. Got to make sure you do the full thing. There we go. See, the put's not overpriced. The call is actually overpriced right now. And that's because I use the buy price, but the sell price is not overvalued right now, is it? So if I switch this back again, I try to sell the call as 225 and I buy the put at 560. It's saying the put is overvalued, but I can't sell it for 560. If I try to sell it right now, I could try to split that and get something more than 430. But if I just go with those prices, the market prices, 430 and 330 for the call, and saying the call is overpriced. But again, if I try to sell it, I have to sell at a different price. So what could I do here? If I am trying to take an arbitrage opportunity, I would try to buy the call at 330, but I would try to sell the put for more than the 430. Because obviously I want to sell it for more than the theoretical value if possible, okay? Level 3 trading, can you do this trade? I forget what level this actually is. I believe, if I go back, does it say it's level 3? There you are. So yes, it does say what level these are. So I forgot, this is not a naked option. So we could actually do this at level 3 because you're doing a covered call basically, or you're doing a married put or covered put. Because remember, if we think that the put is overvalued, we're going to sell the put naked. But in order to make sure we're not naked, we're also going to go ahead and short the stock. So we're not a naked put. If we are buying the put and selling the call, then we're going to go ahead and buy stock. So that way it's a covered call. Okay? And that's all explained in the strategy here as well, the article, what the conversion is all about. But it's kind of neat. Like I said, sometimes the profit is very, very small. And well, the cost, let's see, the trade cost was $4,900 to make 12 bucks. Wasn't all that exciting, right? What was our cost here? $10,000 and basically making 102 bucks. That's a little bit better. And what's my risk? Well, if the arbitrage isn't there, it doesn't come back, obviously I could possibly lose money in this. But as of right now, if I catch this with that arbitrage opportunity, and they're not the easiest things to find. Again, remember, if I go back to ball right now, the only way this becomes an arbitrage opportunity is if instead of selling at 430 and buying at 330, there we go, get rid of those Amazon, I have to try to negotiate that price and get a different credit for this because I'm selling the, selling the put, and I need to get more for that, and I need to buy this for less. There's no guarantee that's going to happen. I could try to put in that order for greater credit, meaning I'm selling at a higher price altogether. And you can see right now, the natural is only $1. The mid, it's already splitting the bid and ask for me by doing that 217. So by getting this for 217, I'm already trying to create that arbitrage opportunity, but there's no guarantee I'll get filled. If you want to get filled very quickly, you go to the natural price, which would be buying at 330, selling at 430. That's why it's a credit of only $1. That will get filled instantly, but there's no arbitrage because you're basically paying the values that are there that are being shown as fair value or put call parity. The parity is there. But if it's a very liquid security where there's a lot of trading going on it, again, if I bring up my columns again, where there's a lot of volume and or open interest, I may have an easier time getting filled at a more advantageous price. Well, right now, the 50s, they don't have much volume. Well, they have zero because it just reset, but even the open interest is a little low. I might be better off going with some higher open interest on the one that's overvalued, so I might be able to get a better price. If enough people are trading it, I have a higher probability of getting a better fill. If it's not as liquid, I may not get as filled at the better price. You know, always when I trade options, I try to do a limit order to get filled somewhere in between the bid and ask. It's not always going to be exactly the mid. It's usually somewhere between natural and mid, if that makes sense. Remember, somebody else has to take the contra for this, and they don't want to give up their profit for you. But this is kind of an interesting strategy. Again, if you can see that there's some serious mispricing or skewed, you can look at a couple different things. Obviously, looking at the theoretical value versus, I'm not sure there's a way of scanning for this, unfortunately. That'd be kind of nice. Scanning for theoretical value versus the mid price, if you will, or just simply going through and seeing very liquid securities. Let's see, Tesla, that's been in the news a little bit recently. Yeah, it doesn't matter what the underlying security price is. I'm just looking for mispricing between the options and the underlying security. That's all. Is there more risk of trading at the money versus out of the money strikes? Not necessarily. Remember, it's just a matter of whether or not they are mispriced. So you could try out of the money or even in the money options. The risk is going to be, one is going to be out of the money, the other one's going to be deeper in the money, right? So for instance, if I do 180 days here, 6 months out, October on Tesla, right now trading at 2.25 roughly, right? If I were to do this out of the money call, that's in the money on the put. So if I'm shorting in the money, I run a higher risk of getting exercised, don't I? Or assigned, excuse me. So perhaps I want to sell out of the money if possible and buy in the money. Yes, I'll be dealing with some intrinsic value, but again, my other underlying security position offsets that. However, if I'm doing that, if I can sell, like I said, out of the money, especially with the call, for instance, let me go up to 270, right? And see if there's any arbitrage there. The theoretical value is $38 on the call. Meanwhile, it's trading at $28. It's $10 difference there. The put theoretical value is 75, and that's trading $10 below. So it may not be an arbitrage opportunity. Let's try it. Again, bring up the calculator. But by selling, if I think the call is overvalued and I want to sell, I'd rather sell out of the money than at the money, because again, it reduces my probability of being assigned because I'm out of the money. So we're looking at Tesla, and we've got, how many months did I say? 6 months, right? There's actually 2 days left, less than that. Strike price is 270. Value is about 264. So now on the 270 option, what do we got here? 270s. The call, let's say we're selling the call, it's 29.70. Actually, we want to buy the call. It seems like it's undervalued, right? So maybe I do that. Buy the call 28.35, and the put for 270 is 65.50. Well, again, I'm selling out of the money at that point, or in the money then. And if we go to, oops, there we go. Underlying is 227.50. Right now, these are equally priced. They're even, and there's no the put call parity exists. So there's no arbitrage opportunity. So the only way there'd be arbitrage is maybe if I could sell the call out of the money. And what do I have there? It's 28.10, and the put in the money is 65.90. Again, it's fine. It's not mispriced. But if I could sell the call for more, let's see, it's only 28.35. It's still not, just the parity's there. So no. And again, if I try the 230 instead, let's try that now. 230. This is at the money option. Again, 230 selling the call, 43.10, and the put 41.15. The underlying price didn't change, and there's no put call parity, but it doesn't show either one of these overpriced for the American style. So even though the put call parity does not exist based on a European style, remember, this is not a European style option, it's American style. So based on that, there's a range, and therefore it is properly priced. We do not have an arbitrage opportunity here. It makes sense that there may not be as much arbitrage because these are pretty heavily traded securities. So you got to kind of balance it out. Thinner traded securities might be more overpriced or undervalued, so there may be an arbitrage, but you might not be able to get the good pricing because there isn't as much trading. So it's kind of a balance you got to find and see if there's something out there. So that's a little bit about the trade opportunities, like I said, and I'll go ahead and end up closing these out so you can see how they actually closed out. I can't do it right this moment, but like I said, what I can do is when the market reopens tomorrow for our next session together, I can go ahead and close these out and show you exactly what happened with that and walk you through the entire trade for next time. So any questions? I have to wrap this up pretty soon, and we're running out of time. I actually am on time for once.
That's awesome.
So any questions I can answer regarding this arbitrage? Again, if you have more questions on that, obviously there's the webinar in the Options Education Center. And of course, when you go back to the Options Education Center, you just go to Learn on TradeStation, scroll down to Options Education, and this recording will be up very, very soon. It's got to be edited and checked real quick. But then if you scroll down, you'll see Options Replay, and you'll see the previous webinars there.
So you would say, Brandon, that most of these opportunities that are found using the spreadsheet are mostly happening when volatility is high, right? And there's a lot of swing in pricing, and
Right.
you find it's these disparities in prices, right?
Right. Yeah. I mean, there's a lot of volatility and yeah, implied volatility rises. That's typically what you're going to be looking for. So you can even, if you were to go back to your TradeStation desktop, you can create a workspace. And in the workspace, as a matter of fact, if I were to do this, just under whatever workspace I already have, I can create add symbol list. Oh, no, sorry, that's not it. Hot list. You can actually go to add new page, hot lists. And one of the places you may want to start searching for in the hot list page, when it brings it up, did I click that right? There are, yeah, it's loading it now, but you can see I have like IV percent change up, or, you can look for high implied volatility or big moves in price, anything that might give you that mispricing, either big jumps in value or right here under volatility list. Actually, let me zoom in. Hope I don't have it on right now. But you can see that we have implied volatility percent change up or implied volatility highest. So the hot list might be a good place to start looking for some of these.
Yeah.
And you just want to make sure that there's good volume for the underlying security as well as good open interest on the options. I really wouldn't want to do this with anything that has less than 10,000 for open interest. And that's the nice thing about Radar Screen is you can actually search that. If you take a look at, well, I have to put open interest in as one of the columns, but I actually have it here. Open interest, all options. You could actually put that in, open interest, all options is greater than say 10,000 and search for that. So yeah, there's a lot of little things you could do to make sure that these are liquid and have high implied volatility. So here I have a little list that is created.
Yeah, pretty cool.
Yeah.
Pretty cool. Any more questions in the chat? I don't think I see any other activity, right? All right, you've taken care of everything. So Brandon, great presentation. Again, those tools are available in the Options Education Center. I think Brandon showed you where to get those. You just go to tradestation.com, learn Options Education Center, and you have the worksheet there that you can start using. In fact, I mean, a lot of those articles already have workspaces and scan examples that you can download. So feel free to explore and find strategies that you can start using right away. Brandon, again, thank you for your time. Thank you for doing this for TradeStation. And everyone, hope to see you in a future event. Make sure to check out our events calendar for the topics that are upcoming. Okay. Have a wonderful afternoon. I'll see everyone next time. Goodbye.